Okay, for this next video lecture, so we will be discussing about the responsibilities of the auditor to communicate matters involving fraud, the management, and those charged with governance. So when the auditor identifies the misstatement that results from fraud or suspected fraud, the auditor should communicate that information unless prohibited by law or regulation on a timely basis to the appropriate level of management. Because in this case, as mentioned before in our previous video lecture, it is the primary responsibility of the management to prevent, detect, and correct any material misstatement due to fraud. So therefore, if there is any misstatement due to fraud that comes to the attention of the auditor, you should communicate it with the appropriate level of management to address such problem. So ordinarily, the appropriate level of management is at least one level above the person who appeared to be involved in the suspected fraud. Okay, so because they are the ones who will implement any corrective actions to those persons who have committed or been involved in this fraud. Okay, and they are considered to be their subordinates. So basically, they can reprimand them. So if the auditor has identified or suspects fraud involving management, employees who have significant roles in the internal control, or others where the fraud results in a misstatement or material misstatement, so he should again be responsible to communicate these matters with those charged with governance on a timely basis. So similarly, if the auditor also suspects that management fraud, the auditor should communicate also these suspicions with those charged with governance and discuss with them the nature, timing, and extent of the audit procedures required to complete the audit, so that those charged with governance will help the auditor in the gathering of the audit evidences. So such communications with those charged with governance are required unless the communication is prohibited by law, but most of the time, most likely, it should be communicated. So communication with those charged with governance is also necessary for any matters related to fraud that are, in the auditor's judgment, relevant to his responsibilities. Okay, and the auditor in this case are also guided with the standard, okay, the PSA, on what is required of them and what are their responsibilities. Okay, so we will continue with the next topic about the responsibilities of the auditor to communicate matters involving fraud to an appropriate authority who are outside the entity this time. So if the auditor has identified or suspects the fraud, that the auditor shall determine whether law, regulation, or relevant ethical requirements require him to report it to an appropriate authority or outside entity. So in this case, the auditor will know if that is reportable. And before he would do so, he should probably ask the legal advice from a legal advisor if that is prohibited or that is required. Another is establish responsibilities under which reporting to an appropriate authority outside entity may be appropriate, okay, for the circumstances. Okay, so he would refer to the standard, okay, and to the code of ethics, and as well as to the legal advisor for these matters. Okay, so those are the responsibilities of communicating the matters involving fraud to an outside party or regulatory agency. Okay, so we will continue with the fraud risk factors. Okay, so what are the factors that increases the likelihood of the occurrence of fraud in an entity? Okay, when assessing the risk of material misstatement, the auditor should consider how FS might be materially misstated as a result of the fraud. Okay, so this was also mentioned and also part of their discussion with the engagement team members. So, in considering the risk of material misstatement that results from fraud, the auditor should also consider whether fraud risk factors are present that indicate the possibility of either fraudulent financial reporting or misappropriation of assets. Okay, so here he should evaluate and assess, okay, its potential existence. What are the factors that influence the existence of this fraud? Okay, so fraud risk factors, these are events or conditions that indicate an incentive or pressure to commit fraud, meaning there is something that pushes the person to do the fraudulent action. So it may be because of an incentive or reward or pressure to do it. Another is perceived opportunity to commit fraud. Okay, meaning there is an opportunity which gives rise to committing fraud. Another is the ability to rationalize the fraudulent act, meaning there is something that benefits the person aside from the incentive. Okay, why did he committed such fraudulent action? Okay, so those are the risk factors, okay, that indicates the existence of fraud. So, however, fraud risk factors do not necessarily indicate fraud actually exists. Okay, but in most cases, if these are present, so basically, um, there is fraud, but not all the time. Okay, so nevertheless, these factors often have been present in the circumstances where frauds have occurred. So the presence of the fraud risk factors may also affect the auditor's assessment of the risk of material misstatement due to fraud as well as the audit procedures. So again, depending on the level or the magnitude of the involvement of the persons within the entity in the fraudulent action, so there is an appropriate response for it, okay, that the auditor should make. Okay, so those are the fraud risk factors. So we will continue with the risk factors relating to misstatements arising from fraudulent financial reporting due to incentives or pressure. So this is the specific examples now of the risk factors. Okay, so in this case, we will have the misstatement from fraudulent financial reporting, and the fraud risk factor is the incentive or pressure. They deliberately falsify the financial statements because of incentives or reward or because there is pressure. So what are the examples? Okay, so examples are financial stability or profitability is threatened by economic, industry, or entity operating conditions, such as there is a high degree of competition in the market and the market is saturated. So, in this case, this is also accompanied by declining margin. Okay, so for the entity to be able to be competitive, so they will show in their FS that they are gaining or profitable, but in fact they are not. Okay, so this is an example of pressure on the entity. So why did they commit fraudulent financial reporting? Okay, what are the other examples? Another is high vulnerability to rapid changes, such as changes in technology, product obsolescence, or interest rates. Okay, so in this case, this is also an example of pressure on the part of the entity. So especially if they are using technology. Okay, so obsolescence, as mentioned before, is equivalent to losses on their part. So, uh, in order for them not to report a huge amount of loss, so probably they would falsificate and or not even report it accordingly. So it will result to fraudulent financial reporting as well. Another example is significant declines in customer demand and increasing business failures. Okay, so again, this is another pressure on the part of the entity to engage in fraudulent financial reporting. Another is operating losses that threats bankruptcy, foreclosure, or hostile takeover. So again, in order for their organization to appear that they are not losing, so they would commit fraudulent financial reporting. Another is rapid growth or unusual profitability, especially compared to that of the other companies in the same industry, unless otherwise they are really performing well. But most of the time, if there is competition, this is quite impossible. So there is something wrong, okay, that may exist, okay, that appears in their financial statements. Okay, another is new accounting, statutory, or regulatory requirements. So probably they do not know how to interpret it, or it is impracticable for them to apply it. So they did not follow. Okay. Another is recurring negative cash flows from operations, or the inability to generate cash flows from operations, while on their FS, it appears that they report earnings and earnings growth. Okay, so this is somewhat the opposite of what is really happening in the entity. So it makes, or they make it appear in their FS that they are earning when in fact they're not, or they're losing. Okay, so the following are examples of risk factors leading to misstatements arising from fraudulent financial reporting due to incentive or pressures. Okay, so another is the first one is about the economic pressures. The second one is the excessive pressure that exists for management to meet the requirements or expectations of the third party due to the following. Okay, if the entity is expected to be profitable, or the trend level expectation of investment analysts, institutional investors, significant creditors, or other external parties, including expectations created by management in overly optimistic press releases or annual report messages. So, in order to meet these expectations, they probably engage into fraudulent financial reporting. Okay, so that it may appear that they meet their targets when in fact they did not. Okay, because of the pressure. Another is the need to obtain additional debt or equity financing to stay competitive. So this is the most common fraudulent financial reporting pressure. Okay, that the entity, the reason why the entity engaged in such fraudulent action, because in this case, in order for them to be approved for additional loan, so it should their FS should appear that they are profitable and liquid. But the question is, why do they need additional debt if they are profitable and liquid enough? Okay, so there is something wrong about it, as well as additional capital. Okay, so the investors or the creditor should look on these things, that there might be some fraud, okay, or deception that may exist in this case, in the auditor as well. Another is marginal ability to meet exchange listing requirements or debt repayment or other debt covenant requirements. Okay, so again, this is the same as the approval of the debt or additional capital as well. So they should make it appear in their FS that they are earning and liquid when in fact they're not. Okay, another is perceived or real adverse effects of reporting poor financial results on significant pending transactions such as business or combination or contracts awards. Okay, so in this case, because of the existence of real adverse effect of the reporting of the poor financial results and a business combination, normally it's either that the competitor buys out uh, the entity, was purchased by their competitor because the entity is having a financial problems or difficulty. Okay, but in this case, um some or an entity would not purchase most of the time, okay, an entity which is losing, because it will add to their expenses or losses at the same time. So someone or an entity will buy um, an entity also who is gaining, but most of the time, if you are gaining, you will not allow to be buy out. Okay, but in this case, most probably, because of these things, um, because of the personal interest or to save, okay, the business, then the management might engage into fraudulent financial reporting. Okay, so another pressure or incentive is information available indicates that the personal financial situation of management or those charged with governance is threatened by the entity's financial performance arising from significant financial interest. Okay, because those management or the management or those charged with governance has financial interest over the entity. So basically, they would engage into fraudulent actions, okay, in order for them to satisfy their interest. Another is significant options of their compensation. So this is an incentive, okay, because there's bonus or stock option being contingent upon achieving targets, okay, such as stock price, operating result, financial position, or cash flow. So if they cannot meet these targets, okay, for them to gain or to receive these bonuses or incentives, so they might engage into fraudulent financial reporting. Okay, another is personal guarantees of debts of the entity. So again, it should appear that their financial statement is liquid and profitable to do so. So if they are not actually, so that's why they engage into fraudulent financial reporting. Okay, another example is that there is excessive pressure on management or operating personnel to meet financial targets. This is the same as what we have mentioned actually in the previous example. Okay, because there are incentives in meeting targets. So if they do not meet it, then they do or engage into fraudulent financial reporting. Okay, so we will continue with the risk factors, this time relating to misstatement also arising from fraudulent financial reporting but due to perceived opportunity. So what are the examples of the opportunities that gives way for engaging into fraudulent financial reporting? So here, these are the following examples. First is the nature of the industry or the entity's operations, which provides opportunities to engage in fraudulent financial reporting that can arise from the following. Okay, first of all is the significant related party transactions not in the ordinary course of business, meaning these related party transactions may not be charged, meaning there is a sale transaction but there is no price charge for their related party, when in fact it has the effect on their financial statement and operations and it should be properly reported. But because of some um, uh, financial or personal interest maybe that exists. So they conceal it or they do not report it. So it will result into fraudulent financial reporting also. Okay. There is opportunity because the transaction is between related parties. So they can conceal it. Okay. Another is a strong uh, financial presence or ability to dominate a certain industry sector that allowed the entity to dictate the terms or conditions to suppliers, customers that may result in inappropriate or non-arm's length transactions. So this is the same as that of the related party transactions as well. Okay. Another is the assets, revenues, or expenses based on significant estimates that involve subjective judgments or uncertainties that are difficult to corroborate. So because of the complexity of the policy or the approaches, so it gives them the opportunity to or not to follow the correct principle or standard in reporting their business transactions. Okay. Another is the significant, unusual, or highly complex transactions, especially those close to period end, okay, and which pose difficult substance over form questions. So this is the same as this one, okay, which is subjective judgments or uses subjective judgments. Okay, another is the use of business intermediaries for which there appear to be no clear business justification. Okay, so in this case, this is also the same as that of the related party transactions where they can conceal this or will not report these transactions. Okay, another is significant operations located or conducted across international borders, okay, in jurisdictions where differing business environment and culture exist. So this poses also a complicated business transactions. So because of this, to simplify things, so there might be some fraudulent actions related to reporting that the entity might commit. Okay. Another is significant bank accounts or subsidiary or branch operations in tax haven jurisdiction for which there appears to be no clear business justification. So when we say tax haven, these are countries which has lower tax rates. So this is where sales of a particular multinational company takes place to minimize their taxes. However, if there is no clear business justification where they do business there, so there is something wrong. Okay, probably there is related party transactions that exist, okay, in that particular region or area. Okay, another is the monitoring of management is not effective. Okay, or internal control is loose. So the result would be the following: domination of management by a single person or small group without compensating controls. Okay, so meaning they can override the controls. Oversight by those charged with governance over the financial reporting process and the internal control is not effective. Okay, that is what we are talking about. So basically, fraud may exist in that certain circumstances. Third is there is a complex or unstable organizational structure. So this is evidenced by the following. There is difficulty in determining the organization or individuals that have controlling entity. There is overly complex organizational structure which involves unusual legal entities or managerial lines of authority and high turnover of senior management, legal counsel, or those charged with governance, meaning the responsibilities, the organizational structure, the management is not clearly defined, and there is some complicated process, and some other top management resolves into resigning or withdrawing from the entity because of such complexity. So, meaning there is really an opportunity for fraud to exist in that manner because there is no standard, no internal controls that exists. Okay, fourth is deficiencies in internal control. Okay, basically, if there is deficiency or if the internal control is weak, then fraud is likely to occur. So, inadequate process to monitor the system of internal control, high turnover rates of employment, of accounting, internal audit or information technology staff that are not effective. High turnover meaning the employees do not last long in the entity, so they resign and then another new employee will come in and then they will resign and so on. Okay. Another is accounting and information systems that are not effective, including situation involving deficiencies in internal controls. Basically, all of this indicates that there can be fraudulent activities that exist in the entity. And in this case, it will lead or result to fraudulent financial reporting. Okay, so those are the different risk factors for the misstatement in fraudulent financial reporting due to pressure, incentive, and perceived opportunity.